Good morning. Thank you for joining us today for the Local Agency Investment Fund 2025 webinar. My name is Lily Osorio, and I am the LAIF Administrator. Before we get started, I would like to go over some housekeeping details. Next slide. Questions. We encourage you to submit questions using the question mark button on the right control of your panel. Please feel free to submit any questions at any time during the presentation. We'll have a separate question and answer period at the end of all the presentations, and we'll respond to any questions received at that time. Captioning. Access to live captioning is available during the program, and there is an address in the chat and on the screen. You can access it via the link as well. Webinar replay. A replay link and transcript will be approximately available in 2 weeks and posted to our website. Technical difficulties. If you experience any technical issues, please try the toll-free number on the screen or the link to go to webinar support. Next slide. Today's agenda. We have California State Treasurer Fiona Ma with our keynote speech, followed by Lindsay Peza of Stifel Financial discussing economic trends. At the end of her presentation, we will have time for a Q&A, and then our investment division team with presentations regarding LAIF and the pooled money investment account from our executive director, Jeff Worm, credit manager and PMIB administrator, Tracy Payne, and myself. Also joining us is our LAIF operations manager, Nicole Milliron, moderating questions. We will conclude our webinar with a question and answer period. So with that, let's go ahead and get started. Next slide. First up is the treasurer. Treasurer Ma is California's 34th state treasurer. She was elected on November 6, 2018, with more votes than any other candidate for treasurer in the state's history, in addition to being the first female AAPI treasurer. Thank you for joining us, Treasurer Ma.
Hi, my name is Fiona Ma, your California State Treasurer. Thank you for participating in our LAIF conference this year. As you know, your money is safe with LAIF, and we are very appreciative of your business and your partnership in making sure that our state remains the golden state. We are the 5th largest economy, teetering on the 4th largest economy, and that's because of our entrepreneurs and everybody working together to ensure that our cities and our counties and our special districts are able to generate the revenues that they can in the most innovative ways, some of them with some of our programs that we offer here or through the iBank or perhaps CalPERS and CalSTRS investments. And so we are trying to make sure that we keep as many jobs and businesses here in California. One of the important programs that we would love for you to help us get the word out is our 8 modules intended for elected officials, but anybody in the finance area that wants to learn and understand a little bit about finances and how government works. So if you could please share that, please review them at your convenience. They're very short, about 20 to 35 minutes each. You can pace it whenever you want. They're very, fun. They are definitely not boring, and they're really intended to capture the audience and easily explain some of these very difficult concepts, especially during the wildfires right now. I think our budgets are going to be a little bit upside down, especially in the LA area, and we are going to do what we can to make sure that we help rebuild, and those that lost their homes can recover and rebuild successfully, and we're all working together very hard. In my office, we have a wildfire resource recovery guide specifically tailored for the Palisades fire as well as the Eaton fires. Those can be found on our website, www.treasure.com. treasure.ca.gov. And that first red box is our wildfire recovery guide. And then if you go under the other resources, there are resources for small businesses, solar, electric vehicles, manufacturing, and others. So I hope that you will access our resource guides and pass it on to anyone who needs it. And if you have any questions or if we can be of service, please email me at askfiona@treasure.ca.gov. Again, that's askfiona@treasure.ca.gov. And Catherine Asprey is our amazing constituent services rep, and that is her main priority, is to answer constituent questions, emails, texts, phone calls, and connect them hopefully with the services directly, or we will refer them to where they can get their answers. So again, thank you for all you're doing. Please stay safe. Please help each other. Support each other. We will get through this. So thank you all for participating, and I hope you have a very productive LAIF conference.
Thank you, Treasurer Ma, for your time. Next up is an economic outlook. A resilient economy, sticky inflation, and aggressive fiscal policy agenda limit downside potential for a Fed rate relief. Presented by Lindsay Pieza, PhD, Managing Director and Chief Economist from Stifel Financial. Ms. Pieza?
Well, thank you. Good afternoon and welcome. Let me start by thanking everyone for joining today and giving me this opportunity to present on the state of the U.S. economy. As mentioned, the title, A Resilient Economy, Stubbornly Sticky Inflation. And now we have this new fiscal policy agenda that, coming together, all of these factors could limit the downside potential for further rate relief from the Federal Reserve. Now, turning to the first slide, as we look out to the new year, I think it's very clear that there are three main factors that are going to continue to drive what we can expect and what we experience in the markets and the economy. The consumer, inflation, and the tough and new policy decisions and initiatives that are implemented by both our fiscal and monetary policy leaders. Now, up until this point, the consumer here in the US has proven surprisingly resilient. Resilient despite the burden of higher costs, higher prices, higher borrowing costs, and even now with a reduction in the use of credit cards. But challenges still remain. And as the backbone of the US economy, any decline in consumer resilience could translate quite quickly into a meaningful decline in top line growth. Now, on the inflation side, inflation had been showing signs of improvement, material signs of improvement. But as of last year, that downward trend has been replaced by sideways movement, and even in some cases, indications of acceleration, as we saw this week in both the CPI and the PPI. And while monetary policy leaders certainly continue to struggle to tame price pressures with this desperation, if you will, to reinstate price stability, a seemingly aggressive agenda by the incoming administration could further complicate the Fed's pathway to achieving price stability. But turning to the next slide, let's begin with the consumer. As I mentioned, a significant source of strength for the economy, and this strength in good part reflecting ongoing solid conditions in the labor market, with hiring still remaining not necessarily robust, but certainly positive in nature. Now, again, the annual pace of job creation, momentum, has slowed somewhat, as you can see here with those red lines over the past couple of years. But even at the current average pace of 166,000 since the start of last year, this still remains well above the expansionary level of the prior three cycles, with the most recent acceleration of the 3-month average up to 237,000. So when we look at the labor market, we're still talking about putting hundreds of thousands of Americans back into a position of gainful employment on a month-to-month basis. And turning to the next slide, we continue to see this type of strength. Looking here at the low level of jobless claims, really bouncing around a very tight range over the past couple of years. And we continue to see these indications of strength in the labor market, looking at the relatively low level on the unemployment rate, falling most recently in the latest report back to an impressive 4% pace. Now, not only is this impressive on a nominal level, 4% is extremely low, but look at where we are in terms of those dotted yellow lines, where we are relative to what the Fed designates as the full employment range. This is what the Fed tells us is the desirable level of unemployment, or the sustainable level of unemployment. Let me say it that way. We're not just at the lower bound of that range, we're well below that lower bound, suggesting that the US central bank still has a good amount of room and flexibility to remain in firm territory before pushing the unemployment rate higher into that desirable or sustainable range. It also indicates that we continue to see, again, these tight-ish labor market conditions with clearly labor demand outpacing labor supply. And it's because of this lingering disconnect between labor demand and labor supply that we're still seeing pressure, upward pressure on wages. Turning to the next slide, you can see wages have been averaging at about 4% since the start of last year. Now, like payrolls, we have lost some momentum. We have come down from an earlier peak nearer 6% back in the aftermath of COVID. But even with that second derivative decline, wages are still about 80 basis points above the pre-pandemic average, suggesting at least some ongoing and further support for the consumers. And at least helping to at least some consumers then feeling more financially viable. Of course, turning to the next slide, not all of the support for consumers as of late have been organic in nature. Consumers absolutely are benefiting from this improvement in wages, as we just saw, a solid 4% pace. Consumers are also benefiting from lingering savings, pandemic savings that we've drawn down a good amount, but there still are some savings out there helping to support consumers. And while elevated interest rates certainly punish borrowers, they also benefit savers. And we've seen consumers benefit from this increase in interest earnings. But that's more on the organic side. Support for consumers has also been less organic in nature in some cases, as consumers are increasingly reliant specifically on buy now, pay later options, turning to 401ks with hardship withdrawals up double digits since the start of the year, drawing down those savings and of course turning to credit cards with outstanding balances rising over 1.2 trillion as of late. Now, there are some concerns about these rising debt burdens. Delinquencies in some cases have already pushed above average, especially for those with lower credit scores and those among the youngest borrowing cohorts. And they could continue to push higher. But broadly speaking, looking here, when we talk about the vulnerabilities of the household balance sheet, looking at the light blue line, you can see that the ratio of household debt payments to disposable income, which is simply a proxy for the health of the household balance sheet, this still remains at a near multi-decade low. So I'm certainly not advocating for consumers to take on new amounts of credit card debt. But what this tells us is that there is still a good amount of spending power, borrowing power on part of the average American that will continue to provide support for this theme of resilience in terms of consumer spending. Of course, turning to the next slide, that's not to say that consumers aren't feeling the pinch from higher prices, higher borrowing costs, the resumption of student debt payments. They absolutely are. And as a result, consumers are slowing the pace of expenditures. Consumers are still out there in the marketplace spending on goods and services, but they are doing so at a noticeably reduced pace. Again, that second derivative decline, a slower pace of still positive expenditures. But that being said, even looking at this decline from double-digit growth to 8% down to 6%, we're now at low single digits. Even at an average pace of 3% since the start of 2023, that's still very indicative of providing solid support for an economy and resulting in top-line GDP well above 2.5%. Now, in fact, even at a lower 2-ish% pace in terms of consumer spending, that would still be enough to provide enough support for top line growth around 2.5%, ceteris paribus, assuming everything else is constant. And that's even before a number of potential fiscal initiatives offer further cushion or adjustment to the household balance sheet. Now, when we talk about the consumer feeling the burden of higher prices, let's turn to the next slide. I think it's important to recognize that not all consumers are feeling the pain equally. For some households, net worth has increased substantially over the past 2 years to the tune of $25 trillion. And that's thanks to a massive run-up in asset valuations via the housing market, via the equity market. But we know that these increases have largely been segmented to those at the upper end of the income spectrum. Because just statistically speaking, we know that those in the middle or at the lower end of the income spectrum are less likely to have a stake in the equity market. They're less likely to own property and thus have largely been precluded from enjoying this massive run-up in household net worth, again, via that rise in asset valuations. And this has really perpetuated the divide, not between rich and poor, but between asset holders and non-asset holders. So when we talk about the resilience of the consumer, as I did at the start of the presentation, we do have to be somewhat careful about painting with a broad brush, because it is clear that there's two very different storylines underneath the surface when we talk about the health of the US consumer. Now let's turn to the next slide and take a look more on the corporate side of things. Just as they've weighed on consumers and households, higher costs, higher prices of parts, materials, higher rental costs, and of course, higher labor costs have also been weighing on businesses, resulting in a significant slowdown in the pace of investment. Now, again, it was that second derivative decline, that slower pace of positive momentum that we saw in payrolls, that we saw in consumption. But it's been a noticeable slowdown over the past 2 years, with business investment, as you can see, declining outright more recently for the first time since the third quarter of 2021. So you can see that turn into negative territory at the end of last year. Again, the first dip below zero since the end of 2021. And I would expect this relatively reduced pace of investment to continue, at least in the near term, as we continue to see uncertainty and volatility around consumer behavior, translating into reduced profits, or at least reduced profit expectations, which could lead to at least some credit quality issues on the margin, resulting in closures or location reductions, layoffs, etc. Now, turning to the next slide, for some companies desperately trying to tread water in this difficult environment, For some businesses, for some companies, they've already resorted to those suggestions, as I mentioned, location reductions, hiring freezes, outright staff layoffs. But the most common pathway that we've seen over the past couple of years in this elevated rate, relatively elevated rate environment, has been a turn to technology, an adoption of AI to help offset those rising costs, particularly those rising labor costs wherever humanly possible. In fact, when we look at the survey data, 50% of businesses in the US say they've already adjusted their staff, their existing employee base, based on the adoption of AI over the past year. And north of 80% of American businesses report plans to reduce their existing labor force as a result of adopting technology or AI over the coming 12 to 18 months. So for many businesses, AI has been a cost savings lifeline, but at the same time, it could also result in a significant disruption in the labor market, potentially displacing as many as 12 million jobs this year alone, and potentially automating north of 30% of current tasks in the labor market by the year 2030. Now, turning to the housing market on the next slide, higher prices and borrowing costs, again, have wreaked havoc on individuals and businesses, but they've also wreaked havoc on the functionality of the housing market, creating a sizable lockout effect by eroding affordability to near record low levels, essentially making it simply too expensive for potential homebuyers to move into the marketplace. But with this rapid run up in rates, this precipitous ascension in borrowing costs, it also created a sizable lock-in effect, largely precluding current homeowners from offloading their existing property for fear of resetting at a significantly higher rate. So maybe you have a big house on the East Coast and you're ready to relocate to a smaller unit on the West Coast, or vice versa. Even if you're buying a lower cost nominal asset, if you're resetting from 3% or below to maybe 7% or higher, that's going to result in a significantly larger monthly payment, which most Americans simply cannot afford at this point. So this adjustment in the marketplace, again, that rapid rise in rates, as well as that nominal increase in rates, created not only a lock-in, but a lock-out effect as well. Still, turning to the next slide, the biggest risk to the outlook and certainly the broader economy doesn't stem from the residential market, but the commercial market, as elevated costs undermine not only affordability for buyers, but valuations for investors. Now, this is something that we've warned about in the past, and it failed to materialize in 2024, but I would argue it still remains a risk now as we look further out into the new year. Remember, in the US, we have trillions in commercial loans coming due in the next 1 to 3 years. And these loans are going to be resetting at significantly higher rates. So that means driving LTVs, or loan to value ratios, from 30 or 40% up to 80, maybe 90%, maybe higher. This is going to require a significant amount of additional capital to right size these loans. Now, that's not to say that this can't happen, but turning to the next slide, as you can see here, in some of the largest key cities of the US, with a return to office ratio, really 50% on the top end in many cases, there may not be the population support to justify a further infusion in capital. And of course, keep in mind that the contagion effect extends beyond the primary office space and extends to all the secondary and tertiary businesses built up around that primary office space. Remember, if we're not physically going into the office, then we don't necessarily need anywhere to park our car or drop off our dry cleaning or get a sandwich during our lunch break. So again, the contagion is not just the primary commercial space, but it extends out to all those businesses reliant on the occupants of that commercial space. And of course, the contagion effect then continues out to our financial institutions as well, as the vast majority of this paper is being held by the mid-size and smaller financial institutions with less than $280 billion in assets on their books. So turning to the next slide, what does this mean for GDP? Because we just talked about the health of the consumer and the commercial market, the housing market, the health of businesses. What does this mean for GDP? Well, taking a broader based view, we do expect the US economy to continue to grow at a positive pace, at a relatively solid pace, around 2.5%. Consumers are still spending, businesses are still investing, but as we talked about, they're doing so at a reduced level. Still positive, but that loss of momentum, that second derivative decline. Now, the risk of recession, turning to the next slide. Still, it remains very real. You can see the risk here. It remains real but muted. Our model puts it at about 15% on the top end as we look out over the remaining months of 25. So it's certainly not zero by any means, but it's certainly not our base case scenario either, as the Fed remains focused on achieving, or in some opinions, maintaining a soft landing. But turning to the next slide, it's important to keep in mind that the US does not have a great track record for achieving that utopic balance of a soft landing, having achieved it, as you can see here, only once in the past 60 years. And I'm being somewhat generous. I'm going over a 60-year period, 11 business cycles, and the Fed has only achieved that once back in the early 1990s under then Federal Reserve Chairman Alan Greenspan, the maestro. So really, when I look at this chart, the bigger risk that I see is not a recession, as we just talked about, or an outright downturn in growth, but the risk of stagflation. As this Powell Fed, remains so fearful of inciting a recession or causing negative growth that it may be willing to allow inflation to remain persistently above the target level for some time, which will eventually choke off upside potential and result in a non-accelerating rate of GDP, or a non-accelerating rate of growth. So sluggish growth, elevated inflation, the very definition of stagflation. And turning to the next slide, as you can see here, this is a scenario that many of our developed and developing counterparts, to be fair, are already facing. This conundrum of sluggish growth and still lingeringly high price pressures, rendering in many cases traditional monetary policy metrics then less than useful in combating these conditions. And this is a risk that becomes increasingly probable for the US given the current fiscal conditions in this country. Turning to the next slide, let's take a look at the the federal government's balance sheet. You can see here $34 trillion in debt, a deficit to GDP ratio at near 7%. That's double the historic average. So the question I'm always asked is, do deficits matter? Does debt matter? And the answer is unequivocally yes. And this massive expansion of the government's balance sheet will continue to reset not only market expectations for higher, longer term rates, which in part is why we've seen yields climb despite the Fed's recent 3 consecutive rate reductions, but it's also going to further complicate the Fed's pathway to achieving that second half of their dual mandate, which is price stability. Now, of course, this is nothing new. Turning to the next slide. In many ways, the US is still reeling from earlier fiscal policy developments. Remember, this massive expansion of government spending did not occur overnight and did not occur under one administration. It's been a cumulative effect over decades. But if you think back to the great financial crisis, the American public, the market, investors seemed to balk at 787 billion. That was the price tag. But this time around, we spent nearly $6 trillion. And regardless of how we feel about these policies, regardless of how we even feel about the administrations that put these policies into place, we do have to have the uncomfortable conversation regarding the consequences of these policies. Now, to be fair, much of the developed world, as you can see here, followed suit in terms of massive outlays of government support during this unprecedented period of the pandemic. But turning to the next slide, let's see what happened in the US. As the US spent more than double the next highest spender, we also created the highest levels of inflation here in the US than most anywhere else in the developed world. Now, that's the bad news. The good news is that's no longer the case. Inflation has improved markedly from earlier peak levels, and we have continued to see at least a stabilization away from those earlier peak levels. But there still is quite a bit of ground to cover before we can talk about the Fed dropping that mission accomplished banner of achieving 2%, their 2% target. Now, moving to the next slide. I think it's also important to recognize that the risks to inflation remain at this point on the upside, particularly amid a new regime entering into Washington with a potentially very aggressive agenda. Now, according to the Trump team, the administration is focused on a number of key initiatives, increasing international tariffs, international barriers to goods coming into the domestic market, potentially lowering taxes, keeping in place the 2017 landmark tax reductions, and potentially reducing the corporate rate as well, putting in place more stringent immigration laws, increasing a more positive focus on domestic energy production, keeping pressure on monetary policy to provide less firm initiatives, and potentially reducing the government's role in terms of this country's healthcare industry. But the question remains, how will these agenda items impact the economy? Turning to the next slide, let's start with tariffs. Because again, as we try to decipher the impact, I think first and foremost, the answer is it will depend. While certainly painful for consumers already reeling from years of price increases, you can see the massive increase in costs since 2020 for very key categories. Groceries up near 30%, housing 26%, transportation over 25%. So consumers are already under pressure from years of price increases. But tariffs in and of themselves aren't necessarily inflationary, as a one-time price increase does lack the perpetual upward momentum in costs that triggers inflation. That being said, this retaliatory tit for tat dispute or back and forth reaction in the international market could absolutely result in inflationary pressures. And in fact, in the most extreme cases, I think could result in several tenths added to annual inflation metrics. Turning to the next slide. In terms of tax cuts, a sizable reduction in a tax burden absolutely could fuel a spending binge on the individual or household side, or an investment binge if we saw a significant reduction on the corporate side. However, at the same time, the Trump administration has vowed to weed out waste and inefficiencies and reduce the overall size of government. So if we could find enough line items, enough areas to reduce expenditures, to offset the potential loss of revenues elsewhere in case of reduced tax initiatives, we could actually offset that potential additional burden on inflation and that potential loss of government revenue, and could potentially add to top line GDP. In fact, I would argue a more fiscally responsible balance sheet could add several tenths of a percentage point to GDP this year alone, or more as we look out over the longer run of the economy. And one more topic to touch on the fiscal side, turning to the next slide. While additional immigration restrictions absolutely could exacerbate the already existing labor supply shortage that we face here in the US, with still more than 8 million job vacancies, and by extension then result in higher production costs, higher wage pressures. On the flip side, looking at this from both sides of the coin, more stringent immigration laws and requirements could help to reduce the reported drains on federal, state, local social programs in particular areas, and potentially return security and order to our southern US border. So again, it's very much going to depend on the exact implementation and scope of policy. But I would add that either way, I suspect a review and potential redesign of US immigration policies will help to bridge the gap between the need for very positive immigration flows into this country to support the US labor force, but also the desire to entice the most contributory individuals into the US labor market with the skills needed to fill those millions of job vacancies out in the marketplace. So for the Fed, what does this mean for the Fed? Turning to the next slide. Well, a bloated and growing government balance sheet, rising equity market valuations, a more spendy consumer, ongoing resilience on part of the consumer. Then you add in international and geopolitical risks, as well as this potentially aggressive fiscal policy agenda that we just went through. And these were far from the ideal conditions that the Fed anticipated to be experiencing, still struggling to reinstate price stability. So it all comes down to inflation. Let's take a look at the next slide. It all comes down to this chart here. Now, again, there has been progress, ample progress from earlier peak levels, but that downward momentum of 2022, 2023, that arrested last year, with many iterations of prices now moving sideways or even accelerating away from the Fed's 2% target. Take a look at the supercore CPI, for example, or housing costs, still more than double the Fed's target at 4.2 or 5% respectively. And with the headline CPI and headline PPI actually accelerating, meaning gaining momentum in the past 4 months, both the PCE and the core PCE, which excludes food and energy, these are the Fed's preferred measures of inflation. These are anticipated to range north of 2.5% over the next 12 months. Again, implying this lack of downside potential for further Fed relief, as well as additional or at least ongoing pressure on consumers. Let's turn to the next slide. Now, despite that lack of improvement in inflation since September, the Fed did opt for a third round cut at the end of last year, with relief now totaling 100 basis points, a full 1% over a 4-month period. But the motivation was largely based on concerns over labor market weakness, which failed to materialize, as well as a need to push through as much relief as possible ahead of the uncertainty of a new Trump agenda. But even with another 25 basis point cut in December, at the same time, the committee was very hawkish, very positive in their assessment of the economy, with Fed officials acknowledging both the upside risks to inflation and the realization that after just 3 rounds of easing, policy was already nearing neutral. The Fed also, as you can see here, materially revised down their outlook for additional rate cuts in the coming years, reducing the amount and the pace of expected reductions. Previously, the Fed had been anticipating 4 25 basis point cuts. That was reduced to half. Just 2 cuts this year, 2 cuts next year, taking us to eventually a longer term rate of 3% out beyond 2027. So policymakers very clearly adopting a more cautious tone, opening the door for a near-term policy pause as we saw materialize in January. And let's take a look at the next slide. As I mentioned, the Fed opting to hold rates steady in a range of 4.25% to 4.5% at the start of the year. And at the same time, the Fed also maintained that very positive language, reiterating a solid economy, noting that the low level of unemployment has seemingly stabilized, suggesting the committee has adjusted its assessment of labor market conditions, moving from earlier concerns of emerging weakness. Policymakers now appear to be conceding to ongoing solid conditions in the labor market and more broadly across the domestic economy. You can also see here the wording on the inflation front. The committee continues to acknowledge the sticky nature of inflation. And while not necessarily accelerating, policymakers noted the still elevated level of costs, removing those that recent wording of further progress towards the committee's goal. Now, turning to the next slide, the January move was certainly a policy pivot away from that earlier pathway of easing, as I mentioned, that began in September. But the decision to hold rates steady at the start of the year, at least for the market, was somewhat of a non-event, given that the move was widely anticipated and had been fully priced into the market for some time. But that being said, with the upwards assessment of the labor market and downwards assessment of inflation improvement, as we saw in the statement, this suggests the Fed is increasingly willing to take a prolonged position on the sideline as the committee continues to assess the evolution of conditions, the evolution of the data, and of course, the impact of fiscal policy initiatives. As we heard from Chair Powell testify this week, there's a lot of uncertainty facing the economy, and as such, the Fed is in no hurry to adjust policy, nor is policy on a preset course. So the committee is going to be very thoughtful, very patient in terms of any further initiatives going forward. And turning to the final slide, now, in terms of expectations for additional policy adjustments, I think it is important to recognize that changing conditions, some ongoing improvement in inflation, some ongoing cooling in terms of job creation, as we saw that slight slowdown in momentum, these do warrant somewhat of a further policy response and thus could warrant additional rate cuts this year. But any further adjustment that we see from the Fed will come at a more tempered, controlled pace as the Fed moves policy towards neutral. This is not a Fed in any way rushing to provide relief to an ailing economy, but again, simply a Fed adjusting firm policy back towards neutral as the data and the economy normalize. But as we've seen, the Fed has very much laid the groundwork for this minimalist approach to any further adjustments, likely translating into the Fed holding policy steady well beyond that January pause, that widely anticipated pause, meaning very few, if any, additional 25 basis points basis point cuts this year. But even if we saw additional policy likely pushed out to the second half of the year, regardless of whether it's one, two, or none, the resulting change for the market seems to be threefold. A structurally elevated level of longer term rates, so higher rates on the longer end of the curve, a welcomed more normal upward shaping yield curve, and potentially a structurally higher R star or neutral level near 3 3/4, or substantially, at least substantially above earlier central bank predictions. But with that, I'd like to leave a couple of minutes for questions, comments, or general disagreements, if there are any from the audience.
Nicole, do we have any questions for Ms. Pieza at this time?
Yes, we do have a couple of questions. The first question I have is, are there any concerns about government debt to annual gross domestic product?
Absolutely, absolutely. As I mentioned, $34 trillion in debt, and that deficit to GDP rate, or deficit to GDP ratio pushing towards 7%. This is going to very much limit growth and exacerbate inflationary pressures, which is going to complicate the Fed's ability to provide relief, that relief that they so desperately want to provide to the economy to continue to accelerate growth. So yes, it's going to create a natural barrier to any further adjustment on the monetary policy side, and also should act as a structural limitation to any further expansion on the fiscal side. But unfortunately, we haven't seen fiscal responsibility in Washington on either side, Democrats or Republicans, for quite some time.
Okay, great. And our next question is, what is your projection of rates for 2025, and how many rate cuts do you anticipate, if any?
Well, I think at this point, it's going to be very difficult for the Fed to justify any further rate relief without two factors coming into play, or at least one of the two factors coming into play. A material arrest of this upward ascension that we've seen in inflation over the past 4 months, or a significant cooling in the labor market. But barring one or both of those scenarios, it's going to be very difficult for the Fed to justify any further policy relief. Now, that being said, with the Fed comfortable on the sidelines, that does not immediately imply an increased willingness to reverse course and hike rates. I think the bar for additional rate hikes has been set significantly higher than for rate reductions. We would have to see ongoing inflationary pressures, and when I say ongoing, probably 6 months or more, before we could talk about the Fed really getting on board with potentially reversing what they started in September. So I think right now the upside risk for additional rate cuts maxes out at 2 this year. That would be the most that we could possibly expect from the Fed, with the downside being no additional policy action unless we see a significant increase in inflation, which could spark 1 or 2 rate hikes. So there's a bandwidth of potential policy action that we could see this year, again, depending on how the economy evolves and, more importantly, how fiscal initiatives impact the economy over the next 6 to 8 months.
All right, so I believe that was our last question. On behalf of myself, the Investment Division, and LAIF, we'd like to thank you, Ms. Pieza, for joining us today in our LAIF webinar.
Thank you very much for having me. Thank you, everyone, for attending.
All right, next slide. Next up is our LAIF and PMIA update, managing a large portfolio of state and local money, presented by the Investment Division team and myself. Hello again for anyone who might have missed it. I am Lily Osorio, and I am the LAIF administrator. Next slide. I'll begin my part of the presentation with introducing you to our amazing team and give a face to the voices you hear when you call in. Next slide. On the top right, next to me is Nicole, our operations manager. Bottom far left is Janice, our lead analyst. She handles new accounts. Chai, she handles transactions and account updates. Christina, she handles transactions and bond accounts. Priscilla, she handles transactions and LAIF online user IDs. And Sarah, she handles transactions and helped plan this web conference. Next slide, please. Source of funds. I'd like to start by showing you how LAIF fits into the pooled money investment account. As you can see, LAIF is only a portion of the PMIA, about 13% of the $151-ish billion portfolio as of December 31st, 2024, which is mostly comprised of surplus money investment fund, also known as SMIF, and general fund dollars. Being a part of the PMIA is how LAIF is able to offer local agencies the opportunity to participate in a major portfolio, which invests hundreds of millions of dollars using the investment expertise of the State Treasurer's Office investment staff. Next slide, please. Here is a look at our participation pie. I like to show this chart because, as you will see, the majority, about 70% of our accounts are from special districts. This image really highlights one of the main reasons LAIF was created, to be an investment alternative for California's local agencies. You will also notice that most of the counties and cities hold LAIF accounts as well. Next slide. Now we'll move on to how LAIF operates, and I'll start with some policy reminders. Our office hours are from 7:30 a.m. to 4 p.m., with staff available during that time to take your calls, whether you want to schedule a transaction, open a new LAIF account, or for any other general questions you may have. Our LAIF online hours vary a little since you are able to schedule a transaction anytime from 7 a.m. to 7 p.m. If you would like more information about our online account management service portal, LAIF Online, please feel free to give us a call or visit our website. We also ask that you please provide us with at least a 24-hour notice with a call or email for any transaction of $10 million or more, withdrawal or deposit. This not only allows us to make the most effective investment decisions, but helps our cash management division, who we work closely with. Same-day transactions must be scheduled via phone or online before 10 a.m., preferably not at 9:58 a.m. Deposit transfers from your bank should be received on the effective date of the transaction. Our regular accounts have a $75 million cap, no limit on bond accounts. You are also allowed 15 transactions per month, with a minimum transaction of $5,000 in increments of $1,000. Next slide, please. I'd like to take this time to remind you of what happens on our end when you schedule a deposit into LAIF and how time sensitive it can be. The clock begins once you schedule a deposit, either online or by phone. You then need to contact your bank and initiate and approve the transfer or wire funds to LAIF. Our team begins tracking deposits around 11:30 a.m. on the effective date, which is about the time you will start hearing from us too for any updates. It is very important that if you schedule your deposit with an effective date, we receive the deposit on the effective date. When we schedule your deposit with an effective date, we begin accounting for the receipt of those funds on the effective date, meaning we begin paying interest. If we don't receive the money on the effective date, we have to make adjustments to your account to correct for the interest, and our cash management team has to make adjustments to the LAIF bank deposits because the state is required to keep a certain amount of dollars in each of the LAIF banks and must make adjustments if we don't receive the expected deposits. So by now you're probably asking, what's the bottom line? Well, if you're ever unsure or have a question about your deposit, please contact us and we will gladly assist you with the process. Next slide, please. account updates. Next up, I would like to talk about LAIF account updates. We can best serve you when we are kept in the loop with any type of change or update to your LAIF account information. When visiting our website, laif.treasurer.ca.gov, you can easily find the update forms by clicking on the Forms blue box. Today, I will focus on the two update forms that are used the most. The first is the bank account authorization form and the authorization for transfer of funds form. If your agency has switched banks, closed a bank account, or if your bank has merged and changed its name or updated their ABA number, we require a bank update form. To ensure there are no delays with your transactions, we ask that you update your banking information accordingly. Lastly is our authorization for transfer of funds form. If your agency has had recent staffing changes, for example, people retire, promote, or you have new hires, we will require an updated authorization change form. We will not process a transaction with someone who is not authorized on your account. We are sticklers with these update forms for your safety and ours, which is why we still require the original of these forms to be mailed and with wet signatures. If you have any questions about these forms, please remember that our team is happy to help, so do not hesitate to reach out with any questions. Next slide, please. Lastly, I will briefly touch on LAIF's quarterly performance as of December 31st, 2024, which leads us right into the PMIA portion of today's webinar. The apportionment rate for LAIF was 4.62%, with the quarter to date being 4.48%. The average life of the entire portfolio was 252 days, with a fair value factor of 0.99. I will note that with LAIF, it is dollar in, dollar out, but we do post this factor as a requirement, as I'm sure your auditors may have asked you about it at one time or another. Next slide. And with that, I will now hand it over to Jeff Worm, the Executive Director of the Investment Division, who will give an overview of the pooled money investment account, along with Tracy.
Okay, next slide, please. I'd first like to say good morning and thank everyone for registering and giving us the opportunity to speak directly with you today. It's an honor to get this opportunity to get to talk to you directly and get through some of this information. Next slide, please. What I'm going to do here with my presentation, I'm going to kind of draw a picture of where we were and how we got to where we are, so there's an understanding, or a better understanding of what we've been doing and how the portfolio got to where it is. This information can be found on the website, and I'll show you where later in my presentation. But if you kind of start on the right side here, at the very top, the green boxes tell you what date ranges we're looking at. And as you go down, it'll show you the average daily balance for the portfolio within that month that we're discussing. A couple other points to look at is the effective yield at that time, and then the average life of the portfolio is kind of where I wanted to point out as things have changed here. The first column there on the far right is the December 31st or December of 21. The average daily balance in the portfolio was over $175 billion. To give you an idea, just in 1 year prior that I couldn't fit on here to make it make sense. In December of 2020, the average daily balance for the PMIA was $103.5 billion. So we had some massive changes leading right into all these rate hikes from the Fed, and there's a lot of things that kind of played into how this worked out. So if you look at it, like I said, so we had a roughly $70 billion increase in the PMIA over one calendar year from December 20 to December 21. That continued to grow into 22, as in December of 22, the average daily balance for that month was $198 billion. But the average life was coming in. I mean, we made a conscious effort, but it's really hard with a very, very large portfolio to make significant changes in anything, whether it's yield, whether it's the average life, and the total dollars will just kind of flow in and out. I mean, with California being the 5th largest economy, you can imagine how much money flows in and out of our system on a daily basis. So if you continue across to December of 2023, you'll see that we've started on the downhill slide of the peak amount of money coming into the PMIA. December of 23's average was 156 billion, and in this most recent December, it was just under 150 billion dollars in terms of average daily balance. But as you can see, the average life was going down, and now it's kind of crept back out a little bit. We do have kind of thoughts that I know rates are potentially going down. There's a stronger potential for them to go down. So we've taken a few opportunities to lock in some rates, in the 4.5 arena, out a little bit longer in the 2 to 3 year arena, which has kind of pushed our average life back out. Because as the portfolio was shrinking, our focus really was on providing enough liquidity to the state and to our local governments, those of you who participate with us, to provide liquidity and not put us in a situation where we had to sell, as it was a little more difficult as rates were increasing rapidly. Next slide. I'm going to kind of show a little bit of history of what the Fed was considering. If we can go to the next slide, please. So leading into like at the beginning of COVID, there were simpler times for the Fed. Rates were zero. This is a normal-ish yield curve where the longer duration, the more reward in terms of earnings that you would get. Much of the Fed felt in September of 21 that rates weren't going to go up a whole lot in 22. They were split on where they were going to end up at the end of 23, kind of settling in around 1%. And we're going to go to the next slide, and we'll see how this is going. Fast forward to the same date range in September of 22. Well, rates weren't at 25 basis points. They were all the way up in the 4 to 4.5 range. Now the Fed is having a little bit harder time to be in agreement on where things are going to go. As you can see, the dots and the voting kind of started getting a little more chaotic because it was really hard to tell for them. And that these are the professionals who work in this world every single day and spend all this time, and even they weren't totally in sync on where they thought rates were going to go, but they were pretty sure as a group rates would be coming back down by 2024. Next slide, please. Fast forward one more year to the September meeting of 23. You can see that rates didn't kind of stabilize there, but they actually did get up to 5.5%, kind of a split there on where they were going to go the next year, but they were sure in 2024 rates should be coming down, which kind of played out right about to where they were looking at here. But if you just go 2 years, there's very little continuity in where they think rates were going to be this calendar year in 2025. So you can imagine these people who are spend all their time studying and reading this are a little confused and have very differing opinions on where rates are going to be. It makes our job and your jobs we all do the same thing, a little bit difficult to kind of predict when we should take the opportunities to invest out term, especially when we've been dealing with an inverted yield curve over the last couple of years. Next slide, please. I'm going to circle back here on the top left of this next slide to a slide Lily shared, just to remind everybody, LAIF is just a portion of a very large commingled pool of state and local government money. And then right below that is a chart I'd like to show how each fiscal year what the PMIA has done. It wasn't until 2019 that the PMIA broke $100 billion for the first time. And as you can see, the steep incline to hit June of 2022, the June 30 number of $234.4 billion. The peak was technically June 23rd of 22 that year. The PMIA had reached $242 billion of total assets. And the average life at that time was still pushing 300 days. And it's really just having to spread this money out over the yield curve to kind of diversify and spread it out. It's really hard to invest the mass amounts of money that was coming in as the state wasn't able to spend money during COVID. We were receiving CARES money and stimulus money just like you were, because if you look at the next chart to the right, it shows LAIF deposits with us also increased as Treasurer Ma was willing to take on more deposits from you to help you park your money when you received CARES and stimulus money. We took on those larger deposits to help you through that same situation. So I just want to kind of show how everything kind of grew at the same time. And then as things have changed and now the money is being spent and you're kind of on a deadline and you had to spend the stimulus money and the CARES money, those monies have come down both on LAIF deposits and on the state's total PMIA assets. Just want to kind of paint that picture for you. Next slide, please. Now, historically, this is kind of the way the PMIA is done. We've always, been one of the largest pools. It tends to make us slow to react. And I'm just showing you different points in time. Top chart is technically on our website right now. It shows you the blue line on each one of these charts is the PMIA earnings at that time. And then the green line is going to be the Fed funds rate. So as you can see on the top chart there in 2019, right before the Fed accelerated down, leading into COVID and all these problems, the PMIA trailed very slowly to down to those same levels. And then, as I mentioned on the previous screens, when we received a bunch of money in 21 and 22, as the PMI more than doubled in an 18-month span and grew to 242 billion. That was exactly the same time the Fed had to start raising interest rates to help combat inflation. So we were put in a very tough situation, an incredibly large portfolio with a longer average life. We were just going to trail. It was just a little bit more impacted because with 75 basis point rate hikes from the Fed instead of the typical normal 25 basis points, when we can kind of stay, in line with each hike. It just showed a bigger separation. It was just the perfect world of how big the portfolio got, how weighted we got in terms of average life, in terms of diversifying and spreading out our investments over a longer horizon to try and tamp it down. It was really hard to, like I said, really hard to invest that large amount of money. A perfect example was in the middle of June of 22, we received $27 billion of federal stimulus money on top of tax receipts, and we were invested $42 billion over 7 business days. And we couldn't find enough product in the short term to invest all of that money. So we did have to take on a little bit of term. And in fact, I think our last investments are in that from that time are maturing at the end of this month in February 28th. The Treasury note that matures on the end of this month will be the last of the investments that we made during that time will be coming off the books. Next slide, please. We continue to focus on the investment policies goals of safety, liquidity, and yield. This is another piece of information that you can find on our website. What I'd like to point out is if you look at the red circle in particular, it's telling you that our Treasury portfolio holdings as of calendar year end are over 50% of the portfolio total PMIA. And then the yellow highlighted section is pointing out the agency investments that we have, which total another 25% of the PMIA. So 80% of our investments are in treasuries and agencies, right up there with our safety. Number one goal is safety in terms of our investments. And the remaining part, including pretty much half of this information that I shared with you, the agency discount notes and technically treasury bills are part of the liquidity portion that goes along with our CDs and commercial paper. So we're hitting those goals constantly. Yield hasn't so much been a focus. The way the PMIA has worked in the past is yield was derived when we took term times to invest out longer, but with an inverted yield curve and a rather rapidly shrinking PMIA, we've really just focused on safety and liquidity over the last year and a half. Next slide, please. This slide is going to kind of show a 10-year, where we were 10 years ago, where we are today, and a 10-year average. Just a couple things to point out. If you look, treasuries have kind of remained at 50% of the portfolio, 56% at the end of last year, and 56% as a 10-year average. A lot of that is due to the fact that PMI is so large that a lot of our investments end up being in treasuries because there is no limit to what we can do by government code in terms of treasuries. They're as safe as they can be, and they're really liquid. I mean, the market's open almost every single day for treasuries. So that's the biggest part there. If you look at agencies, they have grown from 14% of the pool to 25% over that 10-year period with an average of 18%. Excuse me. What I'd like to point out though is the CDs and commercial paper, which tends to be the more yield-driven portion of the portfolio while being shorter investments. When the PMIA was under 100 billion, they was a combined 22% of the PMIA, and now they're at 14%. But the total dollars is a very large number, which I'm going to show you here in a second. So we are still using those as much as we can. Those of you who do this on a daily basis like we do, I'm sure you've noticed that there's a lot fewer options in CP world on a daily basis, especially on the short term in terms of rolling cash short. Next slide, please. This is a portfolio composition breakdown. It's not the total assets. It hasn't stayed the same, but we put the number at the top so you can see how the portfolio has changed in terms of total assets. But what the point is, as you can see, as the numbers have grown So has the Treasury and agency holdings. It's just kind of filled that gap. There's just not, for the size of portfolio, especially when it got to 200 billion, enough CDs and CP in the market for us to kind of keep it more balanced. It's just kind of been a product of the environment that we're having to work in. Um, yeah, and that's where I'm going to kind of move on to the next slide, please. As I mentioned, treasuries help us a lot with our liquidity. And this is a chart that we keep internally. It's not anything we really post on the website, but to give you an idea, that treasuries are huge in terms of our liquidity part. I'll point out the facts. So the green numbers are your treasury bills. These are issued to mature on Tuesdays and Thursdays of every week. The Tuesdays are 4-month treasury bills, and the Thursdays are 1-year bills, 6-month, 3-month additions to what was out on the market at that time. But if you take a look, and we did this for this calendar year, so if you look at this month, February 25, at the very bottom, you look at those numbers of 1.1 billion of treasury bills maturing on the 25th, 4.3 billion treasury bills maturing on the 27th, and 4 billion treasury notes maturing on the 28th. We're not getting any of the money of that back. That's actually to cover outflow for the state, not even taking into account what could come out through LAIF, but it's really the focus on covering our state's cash flow. And we know they have these massive outflows. Even in the next month, if you look at March 11 and 13, these aren't investments, but we're not going to get any of this money back. We're actually still working to cover these days on our cash flow forecast. We know these are massive outflows, and they're really helpful. I mean, it evens out the week if you can stockpile cash on a Tuesday and Thursday to kind of smooth out any massive larger outflows that you have in terms of meeting your cash flow needs. And with that, I'm going to go ahead and pass it over to Tracy, who's going to take over credit and give me a little break.
Okay, next slide. Thank you, Jeff. My name is Tracy Payne. I'm the credit manager, and my responsibilities include monitoring the credit quality of the pooled money investment account. Some of the credit considerations that we take into account when making investment decisions are to invest in only highly rated securities, to diversify by security type as well as by issuer, and to consider the duration of each investment. There are over 100 issuers that are currently approved for investment in the pooled money investment account, and we do monitor the credit quality of all of these issuers on a daily basis. Our number one goal is to ensure that the investments are safe and that they remain in compliance with California Government Code 16430 and the PMIA investment policy. Next slide. This diagram shows an example of the cycle of how we monitor the credit quality of the approved investments. For each of those 100 issuers, we monitor and evaluate their financials, their credit ratings from S&P, Moody's, and Fitch, and we also monitor news information from reliable media sources. The information is collected and analyzed on a daily basis, and we use that to determine if an adjustment in the investment strategy is needed. Examples of changes in strategy that could be made are the duration of the investments, or the maximum amount we will invest in an issuer, or it could even be a situation where we stop investing in an issuer altogether. These adjustments in strategy could end up being something that is permanent, or it could just be temporary until a deficiency with the entity is resolved. And then this cycle is repeated over and over as new information is collected and evaluated. Next slide. About 23 billion of the portfolio on December 31st was certificates of deposit and commercial paper. Combined, they represented almost 15% of the portfolio. As I previously mentioned, we want to ensure we are diversifying by issuer, and this is to ensure we minimize the risk and credit exposure to any single firm or institution. And these graphs give you a great picture of that for the certificates of deposit and commercial paper. Each portion or color of the pie here represents a different issuer or program invested in certificates of deposit and commercial paper on December 31st. It consisted of 31 different financial institution CD programs totaling $13 billion and 36 different commercial paper programs totaling $10 billion. Of the 36 different commercial paper programs, approximately 49% of those holdings were in financial institutions, 29% were in asset-backed programs, and 22% were in corporations. Next slide. Another way we diversify to minimize risk and credit exposure is by spreading out maturities. For instance, 62% of commercial paper was maturing within 3 months and 35% within 4 to 6 months. And certificates of deposit had 51% maturing within 3 months and 41% in 4 to 6 months. And then there was a little bit for each in 7 months and longer. Next slide. Over the last few years, a small amount of corporate bonds were purchased. There were 12 different programs totaling $903 million, which is less than 1% of the portfolio. And one way we evaluate the corporate bond portfolio is holdings by entity. And this graph shows the percentage of holdings for each of those 12 entities. Next slide. And then here you can see we also look at holdings by sector. 43% of the holdings were in corporate names, and the remaining 57% were in financial institutions. And then we also diversify by final maturity date. Each part of the circle on this slide represents the percentage of bonds that mature in each of the next 5 years. Next slide. So still on the topic of credit considerations when making investment decisions is last but not least is to consider the combined exposure by entity. And this pie chart is not actual data, but it just represents how we may look at exposure by entity. We evaluate how much we hold in certificates of deposit and commercial paper and corporate bonds, and we take that into account when making additional purchases of that entity. So to summarize the slides I've shown so far, when considering investment options and looking for diversity, we might consider the type of security, such as CDs and CP, the issuer by sector, such as banks or corporate, and the maturity date or the duration of the investment. Next slide. About 25% of the portfolio consists of agency securities, both federal and supranationals or multilateral development banks. They are all highly rated entities. The portfolio had about $39 billion in both debentures and discount notes on December 31st. $26 billion were in discount notes, which have maturity dates up to 1 year, and $13 billion were in debentures. And in compliance with our investment policies, those maturities can go out 5 years. On the next slide, you can see the diversification of the agencies in the portfolio. They include the GSEs, Home Loan Bank, Farm Credit, Freddie Mac, and Fannie Mae, which collectively totaled $30 billion of the $39 billion in agency holdings. And then the supranationals made up the remaining $9 billion. IBIRD, International Bank for Reconstruction and Development, and IFC, International Finance Corporation, and IADB, Inter-American Development Bank. As part of the credit monitoring process, we do review the information that is published on these agencies by the rating organizations, as well as reliable media sources. For example, this would include staying updated on the discussions surrounding the conservatorship of Freddie Mac and Fannie Mae. Next slide. With such a large portfolio, it is important that we have a number of investment options. We look for fairly large programs that are highly rated with excellent financials, free from headline risk, and in compliance with government code and investment policy. We are limited, sometimes by statute and sometimes by policy, in what we can invest in, or how much, or how long. And we also need to monitor our exposure and credit risk. So we are always looking for new programs to add as an approved investment to ensure that we have plenty of safe investment options to work with. The next slide. The Pooled Money Investment Board. The board includes the state treasurer, Fiona Ma, who serves as chair, the state controller, and the director of finance. The board provides oversight to the pooled money investment account, and among other things, they are responsible for designating the amount of idle state funds that are available for investment, and also for approving new commercial paper programs as authorized investments. And I will turn it back over to Jeff.
Great. Next slide, please. Okay, before I jump into the second half, I wanted to point out the fact that it's an incredibly important job that Tracy and her one analyst that she has working underneath her has for our team. We do invest on behalf of an elected official, so you can imagine there's a little more than even just the credit, constraints and concerns. It's headline risk. We don't want to embarrass the treasurer, and we certainly don't want to embarrass any of our participants in the local agencies. So we do have a team. We meet every morning and discuss everything that we possibly heard in the news that could impact our decisions the next morning. We have a live feed of Bloomberg TV over our investment table, and we're watching it. There have been occasions where a bank's name will pop up with something that might make somebody a little uncomfortable, and we leave that out of our decisions for the day. So there's a lot to what we do, and it's a really great team effort. And I just want to make sure everybody understands how hard this team works for you guys, and I really appreciate everybody here. Just a reminder that I know this has been discussed by Lily already, but I'll remind everybody, LAIF is a voluntary program that's created by statute. It began in 1977 as an investment alternative for California's local governments and special districts, and it continues today under Treasurer Fiona Ma's administration. The enabling legislation for LAIF is section 16429.1 in the California Government Code if you wanted to review it. The pooled money investment account, it's the state treasurer invests the taxpayers' money and manages the state's cash flow to strengthen the financial security of local government entities. The PMI policy is set its primary objective as safety, liquidity, and yield. I know we keep repeating it, but it's important for us to keep that message across. And lastly, the statutory authority that grants the California Government Code, or grants us this possibility to do this for you, is the California Government Code section 16430 and 16480.4. Next screen, please, or next slide, please. I'll give you a quick tour of a way to find some of this information on our website. Two different ways. When you get to the California State Treasurer's Office homepage, at the very top, you'll see the treasurer's picture, and right below that, we've circled in red, you can click on programs, or a little further down the homepage there, you have 7 options here that are blue bars. We've also highlighted the community investments. If you click on either one of those, it'll take you to essentially our homepage, but basically under the programs, when you click on that one, you get a bunch of links listed. You can get a link directly to the PMIA homepage, the local agency investment fund homepage, even time deposits, which is a really important part of what we do on the investment division, and many other STO programs that you might have an interest in here at the Treasurer's Office. But right now we're going to focus on the link that's the community investments link that takes you to the PMIA homepage. Next slide, please. When you get to this next slide, you get 5 different options here. You can get a program description, reporting documents, our investment policy is posted, the PMA statutes that I just mentioned, and the board members that Tracy mentioned. You can get all the information that you need on those there, but we're going to focus on reporting documents for now. So we would click on that and go to the next page, please. When you get to the reporting documents, there's a ton of information here, a lot of which we're kind of sharing and kind of plagiarizing from our own website to share slides with you. Um, if you start on the left hand side there, performance reports, the selected investment data is basically the first slide that I started with. I chose 2 different points in time. They're still on the website. You can find those. Historical rates, something that people tend to find interesting to see where we are and where we've been in the past. One of the items that we starred here, I think one of the most interesting parts for most of the participants is our approved investments, what names we have that are authorized that we can purchase. When you click on that link, it takes you to a page that lists our commercial paper names that we can purchase, the banks that we can purchase their CD programs from, and also any corporate bonds that we can purchase. We have all the approved lists there. So if you're asking, you can find it right there. But what I'm going to focus on right here next, on the next page, is our maturity schedule. So we can go to the next slide, please. This one's really interesting. A lot of good information for people who are curious as to what we're doing, how long we've invested. The blue arrow here points at our total dollars as of the calendar year end on that last day of over $157 billion. A couple other things that I'd like to point out. This chart kind of works its way from, if you go across the top here in the gray bar, it tells you the first month, so 1 to 30 days. These are all the investments in the different categories. And on the bottom, it tells you total investments for the month and a percent of the portfolio as it relates to those maturities. So going into this calendar year, if you look at it, the total maturities, the total line under 30 to 60 days, it's 25 billion just in that month. So well over 30 billion is maturing in the first 2 months of this year, which is way more than the LAIF balances. And then additionally, I'd like to point out, if you look on the bottom line, it's a cumulative percentage of maturities. Within the first 120 days of this calendar year, we'd have 51% of a $157 billion portfolio is maturing. I mean, that's just a massive amount of maturities to think about. That doesn't mean the portfolio is going to shrink by that much. It just means that that's how much we're going to have maturing. That's covering a lot of the cash flow out needs. Very few of that's going to be money that we'll get back, but then the state still brings money in. So the PMI should stay right around 150 billion. I'm thinking is kind of been our par number that it's kind of hovering around, and we'll bump up a little bit over it. Hasn't dropped below it too much yet. 75% of the portfolio matures in the first 9 months of this year. And what I'd like to point out, the duration, I know our average life seems like a really large number in the 250-day range, but really 10% of our portfolio is invested longer than 2 years. It's a small portion, and even smaller is anything over 3 years is only 3.6%. It's a really small amount. And some of those items are callable securities that are probably going to be called. I can't guarantee it, so that's why we listed here. So a lot of this isn't really going to play out to what we're seeing. But I just wanted to share it. This is a really important item if you guys are looking to see where we're heavily weighted in terms of duration or what types of securities are maturing each month. That information is all on here. Next slide, please. On top of our morning meetings, what are we paying attention to on a daily basis? Well, we still listen to the Fed, who Fed Chair Powell was talking again this week, and what's great about not only do we get to watch and listen to him answer questions and kind of portray their message, but we have access to incredible economists in the United States, like Lindsay Piegza, who presented earlier. She was also on CNBC's Squawk Box this morning, so she was really busy. She took the time to meet with us after that. But we get exposure to her and many other top economists that you see on CNBC and Fox Business and all those channels. We have access to them. We get their daily, weekly write-ups and their interpretation of what the Fed was kind of trying to say, even though he may not have said it. Geopolitical problems in the world are a big topic, clearly, and we're paying attention to what impacts those could have on us, whether it's federal money coming in or any changes in those plans. We continue to watch any oversight in terms of it relates to banks, as we have a lot of investments with banks. Our time deposit program, works with a lot of the smaller banks here in California, so we're constantly looking at the oversight reports. We continue to work on keeping up as much as we can as GASB keeps making adjustments to what they need to cover. But we're staying on top of everything as much as we can, and with the team that we have, and we're doing a great job. Next slide, please. A couple more pictures I wanted to present before we're done for the day. Here's the Treasury curves over the last the previous 3 Septembers, September 21, 22, and 23. I just wanted to give you an idea of how things changed just in those 3 years. The bottom broken green line was September 30 of 21. COVID's kind of getting activated, but rates were 0. That is a normal, what we deem historically as a normal yield curve. The longer duration, the higher your return would be. A year later, rates are moving up. The Fed's hitting the accelerator in terms of raising rates. And it's still well, at least from our perspective, being limited to 5 years investment horizon. That's a normal yield curve, a little bit of a inversion from 3 to 5, but not enough that it would stand out. And then if you look at September of 23, it really got inverted. Things started to kind of tip the other way. And we'll go next slide, please. We're going to add another year later to the September of 24 yield curve on this next slide. There we go. It's the solid green line that's at the very top left. It's the second starting line. As you can see, it's totally inverted from 1 month to 3 months to, out a year, 3 years. There's no pickup for taking on duration. So it's been kind of not appealing, but then you also have to factor in the fact that we know the Fed's goal is kind of a neutral 3% range, as Lindsay reminded us today. So do we take out term to kind of compensate for that? So these are things to consider when you're looking at opportunities to invest. Next slide, please. Another interesting picture I wanted to show is the last two calendar year end treasury curves. December 31 of 23 was a massive inversion yield curve. It looks crazy. And then this December 31 of 24, it's kind of normalizing, I would say, a little bit of an inversion from 1 month to 1 year, but from 1 year out, you get a little bit of a pickup. Next slide, please. This slide, I wanted to go back and take a look at what happened with the treasury curves the last time rates were at 5%. So that was in 2006. I picked a few months before the Fed started cutting in both situations here. And so if you look at the gold line, that was the June 30 of 2006 treasury curve. And I drew a blue arrow to show you the pickup from, at this time, it looks like it's 3 months to 3 years, or no, 2 years. I use the 2 year because that tends to be the one that we invest the most in when we do our ladder investing. And then the green one for the most recent one, it's a massive downplay from what the 1 month to 2 years is. So it's a little bit tougher to, again, like I said, invest out longer in terms of taking a look at it. Just want to show you the difference of those two time frames. Next slide, please. Okay, one of the previous directors I worked under here in the investment division always used to like to use the term driving the PMI is like driving an aircraft carrier, and as things would change, it's really hard to steer around or make sharp turns. So that was his analogy to say that the PMI is going to trail anybody else that can move faster, or the Fed funds who can change their rates in 1 day. That's not going to happen. So if you look at the picture to the right, it's the same chart, but just an older version of the chart that I showed earlier. So as rates climbed to the 5% threshold, the PMI was trailing it back then. And then as it got caught up during the peak, and then when the Fed started cutting the green line, the PMI trailed it rather significantly. And again, it's a larger investment portfolio, and we're just slow to respond to faster movements like that. So this is almost the exact opposite situation that we just faced as rates went up much faster. Again, this is a chaotic time to invest in the world that we invest in. So I have a couple little motivational things up there, just adapt and overcome. But the biggest thing is to stick to your investment policy goals. For us, it's still going to continue to be safety and liquidity. And we're going to focus on those things repeatedly. It's really important, clearly, to have the state of California need the cash it needs on hand every day, and also the LAIF participants. Next slide, please. Just a couple pictures to show an example of bond ladder investing. Like I was mentioning, we tend to buy a lot of the 2s and 3 years, and when those mature, if we have proceeds come back and have extra, we will roll those proceeds, the excess over what we need that day, into the new 2 year or the new 3 year as those things mature. So it just kind of shows you how that plays out. Barbell strategy is another thing that we use. This is every day. Most of the focus is on the dollar sign side, which is your liquidity and providing as much liquidity for the pool itself, and focusing on the cash, the immediate forecast that we have. And then usually in a normal interest rate curve, you can do out time, which is the time you take longer duration to pick up some yield. So eventually, I think we're going to get back to those types of investment opportunities. Next slide, please, which I think is going to be my last slide. Again, just reminding everybody, I know you're tired of hearing it, but safety, liquidity, and yield is our focus, and it will remain our focus. Our goal is to make sure that you continue to have access to your money and that your money continues to be safe and LAIF. We take, cybersecurity as serious as we can. We're following up. We're working with our IT constantly. They're working, reaching out to people. All of this is incredibly important, and it's not forgotten. And we appreciate you being participants with us. And with that, I will pass it back to Lily.
Thanks, Jeff. Next slide. Okay, so here you will find our division contact information. Like I've mentioned many times before, please feel free to reach out to any of us with any questions. We will now move on to our Q&A portion. Nicole, can you give us our first question?
Does Gatsby 31 apply to LAIF?
I can take that one. Yeah, I'm pretty sure that's included in our act for every year. We always mark that we're complying by it. It's, if I were to, let me bring up Gatsby 31 real quick, because I get confused as to each one, all the fun rules they have. Let's go. So the summary of that one, much of it doesn't apply, if I remember correctly, now that I'm going back to it. It's talking about external investment pools, which we are not doing. Participating interest earning investment contracts, we don't have that. We don't invest in mutual funds, but we do have debt securities, and we do not invest in equities or options. So a very small portion of this applies to the PMIA. We do comply with everything that GASB relates to. So.
Okay, our next question is, does LAIF expect for the fair value loss to reverse in the coming calendar year?
Tracy's going to let me take this one. Okay. Historically, as rates go up, the number, the factor will go down below par and vice versa. So if the Fed continues to lower rates, then yes, I fully expect it to break par again, which it had before the recent uptick in rates. There was a couple months there where the factor was over par again, but then there was a pickup in rates as inflation got a little bit hot. Even though the Fed isn't raising rates, the market itself was pricing itself a little bit higher, which kind of affected it, and it's just below par now. But yes, as the Fed kind of tightens again, or loosens again and kind of brings the money back and lowers rates, I think we're going to see that number stay over, and as long as rates go down and then stay flat from there, we should be good.
Okay, our next question is, will you be changing the method in which counties will receive interest, monthly versus quarterly?
Okay, so I will take that question. When we pay interest is actually written in government code, so there is no intention of changing that, but please be assured that you will receive interest within the month after quarter end.
Okay, our next question is, does the PMIA publish any information on the fund's realized gains and losses and current unrealized gains / lost position?
No, that would kind of relate to the factor itself. We do amortize every quarter, so the quarter end number is much more accurate than what you might see on the monthly market valuations. But the quarter end, after we've amortized the portfolio, you get a full picture of what the factor is and the value that includes all of that, the accrued earnings and the street value at that time. So that's probably the best way to answer that question. But no, we don't do that in terms of breaking it down into different categories now.
Okay, thank you. Those are all the questions I have for today. If we did not get to your question, we will reach out to you individually with more information.
So since that was our last question, I'd like to thank our keynote speaker, Treasurer Fiona Ma, and our guest speaker, Lindsay Peza from Stifel Financial. And on behalf of myself and the investment division and Team LAIF, thank you all for joining us and participating in our 2025 LAIF webinar.